When we developed our audit program, we had a key consideration, which was a preliminary assessment of the risk of material misstatement. Now, we didn't do any risk assessment procedures back then, but it was just a preliminary assessment. This preliminary assessment could be based on our prior experience with the client. If it's a new client, maybe based on the documentation that we could see from predecessor auditors. Now guys, it's very important for us to understand the concept of audit risk. Audit risk is the risk that we, the auditors, issue a wrong opinion on these financials. So guys, remember, management is responsible for the financial statements. We as auditors, we are responsible for our opinion on these financial statements. And if we issue a wrong opinion, that's the audit risk. That's our worry. That's the risk that we give a clean opinion on materially misstated financials. It's something like what Arthur Andersen did for Enron. So Enron had cooked up financials. They had materially misstated financials. But Arthur Andersen signed off on that. They gave a clean opinion. That's audit risk. Guys, this is the risk that gives you sleepless nights as auditors. It keeps you tossing and turning in bed. So, audit risk consists of three elements. So, you have audit risk or AR, which is equal to IR or inherent risk into CR, that's control risk, into DR, this one's detection risk. So IR or inherent risk is the risk inherent, assuming no internal controls exist. It's how susceptible is the element to risk. Let's say I got $1 million in hard cash. I keep it on this table right here. I go out of the door, keep the door open, come back the next day. Will I find the $1 million out here? I don't think so. How about the tables? Will anybody take these tables away? No. This is because cash, the hard cash, that's got high susceptibility to risk. Nobody's taking the furniture. That's low inherent risk. But cash, high inherent risk. Let's take an example of a diamond merchant. So he's got a lot of diamonds across his shop. There's a big risk that somebody might just pocket those diamonds and walk away. That's inherent risk. The diamonds in his shop, they've got high inherent risk. They are highly susceptible to risk. The next one, CR, this is control risk. So I told you the client has got internal controls that create the financials. Now control risk is a risk that the client's internal controls will fail to detect the material misstatement. So that's a breakdown of the client's internal controls. So let's say our dear diamond merchant, he's got all the diamonds which have got high inherent risk. So he puts in a lot of security guards to guard the diamonds. Now, how about the staff in the shop colluding with the security staff and stealing the diamonds? That's a failure of internal controls. That is control risk. So guys, inherent risk is susceptibility to risk. Control risk is the failure of internal controls. It's the risk that the client's internal controls will fail to detect the material misstatement. Now, as an auditor, we do not have control over inherent risk or control risk. We only assess them. We assess how much of inherent risk does the client have in his business. So let's say if the client is doing a business which is totally based on cash sales and cash purchases, that's high inherent risk. Cash, high inherent risk. Let's say the client is a diamond merchant, high inherent risk, a lot of diamonds, a lot of inherent risk. CR is control risk. Now guys, I told you, management is responsible for financials, we are responsible for our opinion on the financials. Management is responsible for internal controls, we only assess the internal controls. So management puts the internal control in place and we assess what is the control risk. What is the risk that those internal controls which have been placed by the management will miss a material misstatement. Now we come to the last element of audit risk. This is detection risk. This is the risk that we the auditors, we will fail to detect a material misstatement. Either we've taken a bad audit sample or we've done a bad job as an auditor, but we have failed to detect a material misstatement on these financials. We've given a clean opinion. We failed to detect it. Guys, this is very important. So if you realize, let's say, the client's internal control misses a material misstatement and it's there on the financials. But we as auditors, we detect that misstatement. We give them an audit adjustment. We ask them to change it off because we have detected it. Will the financials still be materially misstated? No, because we have detected it. We've caught the loophole. How about, let's say, the client's internal controls are very strong. So the client's internal control, that does not miss any material misstatement. So you've got every issue, the internal controls take care of that. The financials that the client gives to us, that's all fair. It does not have a single material misstatement. Even if we don't do a good job as auditors, the financials, they are good. So guys, now I hope you're understanding. If we can keep any of these components to very low, we can reduce our audit risk. So let's say if control risk is 0, that means the client has got perfect internal controls. Will there be material misstatements here? No. So we've got no audit risk. Let's say control risk is high, that is the client's internal controls aren't so good. But we do a great job as auditors. We don't miss out anything. We do a very wonderful job. So our detection risk is 0. The risk that we will miss a material misstatement, that's, as I said, 0. In that case, what's audit risk? 0. So guys, to keep audit risk at a low level, we have to make sure that either of them, okay, if it's not 0, it should be at a low level. If the client's internal controls are good, then we can afford to have a higher detection risk. So if client's internal controls are good, that means control risk is low. We can afford to have a higher detection risk. Guys, you're understanding this, right? This is a product. So if this is low, to keep the same level of audit risk, we can afford to have a higher detection risk. But if the client's internal controls are bad and control risk is high, to minimize our audit risk, we have to keep the detection risk low. That means we have to do more work. We cannot afford to miss a material misstatement. Now, we'll talk about in detail when we're doing substantive tests. That substantive tests contain test of details as well as analytical procedures which help us understand what our detection risk is. Now, as I told you, as auditors, we assess inherent risk. We assess control risk. Detection risk is something that we determine. So guys, if we do more work, if we work really hard as auditors, our detection risk, that's low. If we do less work, detection risk is high, because the more the work we'll do, the lesser the probability that we will miss a material misstatement. Now, you have IR into CR is something that we assess. Now, IR into CR or inherent risk into control risk is also called the risk of material misstatement or RMM. This is the RMM that you have here, risk of material misstatement. This is something that we see, we assess. DR is something we determine. So audit risk is IR into CR into DR, or you could say audit risk is RMM into DR. Now I've talked about controls. Let me just try to put it on the board here. So let us say that the client's internal controls are strong. The reliance on internal controls, you would say it's got good internal controls. So you want to rely on internal controls. This strong internal controls. What happens to control risk? If internal controls are strong, how much is the risk that the client's internal control will fail to detect a material misstatement? So if it's strong internal controls, they will detect all material misstatements. The control risk, that'll be low. So if internal controls, let's say, if internal controls is strong, then control risk, that's low. If control risk is low, that means the client's internal controls are so strong. Do you really want to put a lot of audit work there? You would say control risk is low. How about I afford a higher detection risk? The audit risk could be at the same level. So if you reduce this, you can afford to increase your detection risk. So you would say if control risk is low, you can have a higher level of detection risk. Higher level of detection risk means you can afford to have a risk that you would miss a material misstatement. That means you would do less work, so less substantive testing. So guys, this is very, very, very important. So I hope you're understanding this. If internal controls are strong, control risk is low. If control risk is low, we can afford to have a higher detection risk. That means we can do less work as auditors. Let's change the scenario. How about, let's say, internal controls are pathetic. The client has got very bad internal controls. What happens then? What happens to control risk? Yeah, exactly. The control risk increases. So as auditor, what do you need to do with the detection risk? If control risk is high, what do you do with the detection risk? Lower it. Exactly. So if control risk is high, you would want to keep a low level of detection risk. If the client's internal controls are bad, they will have all cooked up financials here. The financials will be totally materially misstated. Then you as an auditor, you cannot miss the material misstatement. You have to see everything out here. You have to keep a low level of detection risk, and you got to work days and nights. You got to work 150 hours a week to find all the errors there. So your substantive test increases. So guys, these relationships, they are very important. Trust me, if you know these well, you can do a lot of questions on the CPA exam. Important thing to understand, if internal controls are good, control risk is low. If internal controls are bad, control risk is high. If control risk is low, we can afford a higher detection risk. If control risk is high, we need to have a lower detection risk, guys. Otherwise, our audit risk is going to increase. Think about it. If control risk is increasing, our audit risk will increase. How do we control the audit risk? By lowering detection risk. So that is what we do. If control risk is high, we lower detection risk. Higher detection risk means less work. We have a good time out there. Lower detection risk means lot of work. As I told you, 150 hours per week. So guys, this is the concept of audit risk and very important. Okay, let me also talk a bit about materiality here. So let us say we have a particular account balance. Let's say the account balance is of $1 million, 1 million. And let us say something that we think is material to this account balance, let's say its accounts receivable is $5,000. So we say that anything below $5,000, that is immaterial, doesn't matter. Anything above $5,000, that is material to $1 million. Now, if audit risk is high, if there is a high risk that there may be material misstatements, what do? We might want to do more work. We might want to do more substantive testing. In that case, we would reduce the level of materiality. We would say not 5,000, but $2,000 is the level of materiality. We'll do more work. Remember, when this 5,000 was a level of materiality, we said this is the scope of our audit, for which we give a reasonable assurance. If we find audit risk to be high, then we'll increase the scope of our audit. We will lower materiality and increase the scope. So guys, audit risk and materiality are inversely related. If audit risk increases, materiality decreases. That means you end up doing more work. So instead of doing so much work, $5,000 to $1 million, you do work from $2,000 to $1 million. So your scope increases, your work increases. As audit risk increased, you lowered materiality. How about we say audit risk is pretty low, the client's doing a good job, they've got strong internal controls. The internal controls will not miss out a single material misstatement. In that case, we can increase the level of materiality. Instead of saying $5,000, we can say $10,000 and our work would reduce. So guys, this is the concept that we're talking about here. Very important for you to understand. Now, this is not exactly a part of planning, but I gave to you right here in planning so that you're very thorough with these concepts when you come to it in Audit 3. In Audit 3, when we're doing internal controls, that's when we'll deal with control risk. In Audit 4, when you're talking about substantive testing, that's where you have detection risk. So the audit risk model is all you'll have for the next few days when you're studying auditing. Guys, it's going to be a lot of fun, and trust me, this is very important. Let's get to page 16, and here we're talking about audit risk. And I want you to write risk that the auditor will give a wrong opinion, and underline wrong. So audit risk is the risk that the auditor will give a wrong opinion. Continue writing, right? That is issue unqualified opinion. That's a clean opinion on materially misstated financials. So audit risk is the risk that the auditor will give a wrong opinion. That is, he will issue a clean opinion though the financials are materially misstated. That's the risk. So audit risk, as we see on the chart there, is a function of risk of material misstatement and detection risk. Now RMM, or the risk of material misstatement, includes inherent risk and control risk. Guys, this is a very good chart on this page, and I would want you to review this in detail on your own. Moving on to page 17, we have highlight audit risk. That's the risk that the auditor expresses an inappropriate, that's a wrong audit opinion when the financials are materially misstated. So when we talk about material misstatements, we are talking about highlight materiality. And when we look at materiality, we look at underline both qualitative and quantitative considerations. And we are looking at highlight misstatements. Now, a misstatement is the difference between the amount or the classification, presentation, or disclosure of underline reported financial statement item, right, versus what is underline required. So misstatement is the difference between reported versus what's required. And if that misstatement is material, that's a worry as auditors. Turn to page 18 and highlight audit risk. That's equal to the risk of material misstatement multiplied by detection risk. Now, RMM, or the risk of material misstatement, is highlight the client's risk which exists independently of the audit. Now, RMM, or the risk of material misstatement, that's got two components: inherent risk and control risk. So the first one, highlight inherent risk. That's the susceptibility of a relevant assertion to a material misstatement, highlight assuming that there are no related internal controls. So these are basically, right, errors inherent in the nature of client's business. So for inherent risk, we know that, right, auditor assesses but can't change IR, and underline assesses. Next we have highlight control risk. That's the risk that the entity's internal controls will fail, which is, right, client's internal control misses the error. Right there, auditor assesses but can't change CR, and underline assesses. So the auditor makes an assessment of risk of material misstatement, which is the client's risk, which is already there. And RMM, or the risk of material misstatement, has two components, which is IR, or inherent risk, and CR, or control risk. Once again, so audit risk is equal to RMM multiplied by DR, or detection risk. So highlight detection risk is the risk that the procedures performed by the auditor will not detect a material misstatement, which means that, right, the auditor misses the error. Now, detection risk, highlight, can be altered by the auditor by changing the net, or the nature, extent, timing of substantive tests.
So basically highlight greater the RMM, lesser the DR needed, which may be achieved by altering. Highlight nature, extent, and timing of substantive tests. Now, when we learn about substantive tests in Audit 4, I'm going to tell you that substantive tests, they include underlying test of details and underlying analytical procedures.
Here we have a good relationship between the components of the audit risk model. Look at the top. It says AR is equal to RMM into DR. That's risk of material misstatement into detection risk, and RMM is inherent risk into control risk. Come down on the last sub bullet there. It says auditor uses assessment of RMM as the basis for determining an appropriate level of DR. Highlight here. Detection risk or DR should bear an inverse relationship to RMM, that's inherent risk into control risk. Continue highlighting. If assessed that RMM is high, DR should be set at a low level. And the next one, also highlight if assessed that RMM is low, higher DR can be justified. So that means if RMM is high, we need to have a low detection risk. But if RMM is low, the auditor can justify a higher detection risk. Put a note there which says auditor revises net of substantive tests to determine DR. Once again, auditor revises net, the nature, extent and timing of substantive tests to determine DR. Let's put a little bit of notes on the bottom of this page, and I want you to write RMM is equal to IR into CR. And then write AR, that's audit risk, is equal to RMM into DR, that's detection risk. Then write therefore AR is equal to IR into CR into DR. Very important. And then write therefore DR is equal to AR by RMM is equal to AR divided by IR into CR. Guys, this is just mathematical interpretations. So we say that risk of material misstatement is a function of inherent risk and control risk. Audit risk is a function of the risk of material misstatement and detection risk. So in other words, audit risk depends on inherent risk, control risk and detection risk. Now, if you look at the formula which says DR is equal to AR by RMM, which means if RMM is high, we need to have a lower detection risk. But if RMM is low, we can afford to have a higher detection risk. Guys, just look at the mathematical implications of the formulas that we have put in. For better understanding, let's put a little bit of notes there. Put a note which says if IC are good, that is if internal controls are good, we can afford to have lower control risk. And then because a lower control risk would mean a lower RMM, we can afford to have a higher detection risk, which means that we need to do less of substantive testing. So guys, just look at the implication there. If reliance on internal controls is high, control risk is low, that means we can afford to have a higher detection risk and we can do less audit work, less substantive tests. And right below that implies, so implication is number one, if CR is low, may raise DR. And within brackets, so that audit risk or AR is unaffected. Number two, good internal control or good IC is equal to less work by auditor. On the right, put another note which says if IC are bad, that means pathetic internal controls, rely on internal controls is down, control risk increases, And we need to have a lower detection risk. How can we do that? By doing more work, more substantive tests. So right, the substantive test increases. Write the implications there. Implies number one, if CR is high, need to decrease DR so that audit risk is unaffected. Number two, bad IC or bad internal controls is equal to more work by auditor, more substantive tests, more audit procedures. So guys, now I think it's making a lot of sense. You know what is audit risk, you understand the audit risk model, you know what is inherent risk, control risk and detection risk. You know how to alter your detection risk, because as you understand, the auditor only assesses inherent risk and control risk, but he determines detection risk. Detection risk is something which is in the auditor's hands. Now, if internal controls are very good, I would say I can rely on the internal controls. There is a very low amount of control risk. So the auditor can increase detection risk and do less work. But if internal controls are bad, reliance on internal control falls, control risk increases, the auditor needs to reduce detection risk. How do you do that? By doing a lot more of audit work.
Move to page 20, where we got auditor's risk assessment during planning and performance of the audit. On the third sub bullet there, we have that the components of audit risk, that's IR, CR and DR, or RMM and DR. Now these components may be assessed in underlined quantitative terms, for example percentages, or underlined non-quantitative terms where you use high, medium or low risk. On the next sublet, highlight consideration of audit risk, which is done at highlight the financial statement level, so the overall financial statement level, as well as highlight at assertion level when we're looking at balances, transactions and disclosures. And there is highlight an inverse relationship between audit risk and materiality.